In a meeting held on Wednesday, the Monetary Board of the Central Bank of Sri Lanka decided to reduce the standing deposit facility rate and the standing lending facility rate of the central bank by 250 basis points to 13% and 14% respectively. The board arrived at this decision with a view to easing monetary conditions in line with the faster than expected slowing of inflation, gradual dissipation of inflationary pressures and further anchoring of inflation expectations. The commencing of such monetary easing is expected to provide an impetus for the economy to rebound from the historic contraction of activity witnessed in 2022 while easing pressures in the financial markets.
From the monetary policy point of view, as we indicated earlier, on the beginning of this year, we first started kind of easing monetary policy in terms of first allowing market interest rates to come down, moving towards our policy rates. As you can remember, AWPLR was 29% at the peak. Treasury bill 3 months rates was, I think, peaked at 33%. Both came down. Bill rates 3 months like 24%, others 1 year 22. There has been a significant downward adjustment as requested. AWPLR prime lending rate also, I think, close to 21, close to 20%. Now it's moving in that range until last week. Now the next phase of monetary easing, what we thought, especially what we are seeing in terms of balance of payment pressures easing, currency appreciating, we are building up our reserve positions, and economy also getting back to normalcy. I think as we predicted, but much earlier than a lot of other people thought, its recovery is happening fast. We thought we need to continue the recovery because we have stabilized economy, now it's a recovery process. So to support that, we now, today is the start of the policy easing cycle. We reduce our policy rate significantly by 250 basis points. I hope banks, especially one of the issue that SMEs and other lenders, the borrowers are facing, private sector, even the government, relatively high interest rates, but still in high inflation environment. But we see very clearly inflation coming towards our target range much earlier than what we expected, supported by currency appreciation. Adjustment in the fuel and petroleum prices, global prices, all are helping favorable conditions, have helped us to bring the situation much earlier than under normal circumstances. That's why we think now it's time to relax monetary conditions. So we took this strong adjustment of policy rates. We hope that banks will transmit and bring down especially the lending rates for businesses, those who are finding it difficult to service their loans. We know that some stresses we have seen, so that will ease the pressure, and also that will basically, hopefully, will start gradually the banks expand their loan books. Credit will be starting to flow into the businesses' economy, and with that, the economy will try to recover. And also to support that, already in terms of foreign exchange situation, we relax the margin requirements already for LC margin requirements. And also I think we are in the process of relaxing some of the foreign exchange capital account transaction controls. That also will be relaxed. We already submitted proposals to the Minister of Finance, and also we are recommended to relax some of the import restrictions. Those have been relaxing gradually, but in the next phase, I think we would like to relax further to support the economic activity, especially industries, raw materials, intermediate goods, innocent goods. I think we hopefully will be relaxing first in the first phase. Those all will certainly help economy recover faster. In terms of foreign exchange situation, I would like to update some information that they're supposed to. I think already we saw 3.1 billion level of reserves end of May number. I think we have already announced here. Also, the usable reserves, that includes the PBOC SOP. Even without that, I think we have about $1.6 billion on usable reserves. And also in terms of our intervention in the foreign exchange market, a lot of people are asking currency appreciation. So far during the year, we have purchased from the market on net basis $1.671 million from the market. During the month of May itself, we have purchased from the market $662 million, which is one of the highest in the recent years within a monthly period. If we did not intervene and purchase, I think probably currency would have seen much more volatility and sharp appreciation. So we want to maintain certain stability by intervening. Also, that has given us opportunity to build up our positions. So that has given much more comfortable reserve position compared to where we were, which is not very comfortable. Still, we need to build up our reserves. But this is compared to where we were, we are in a much better position now. So these are the brief remarks that I would like to share before I open up for discussion.
Journalists questioned as to how soon the change in interest rates would come against a backdrop where the interest on treasury bills are above 25%.
The uncertainty is because the government has still not announced their plans on debt restructuring. The highest interest rates are on treasury bills. We call it the premium of uncertainty. It will reduce a lot once the plan is announced. We hope that the rest would also reduce in due course.
So debt restructuring mainly is the borrower is the Minister of Finance, the Treasury. They certainly will announce what would be the strategy by the Minister of Finance. That also I think up to the Minister of Finance. We are the kind of a recipient, we are regulator of the financial stability, custodian of the EPFs. We are basically looking forward for a government proposal.